Hi everybody. Today we're going to be discussing Financial Accounting Chapter 3, Measuring Business Income. An important purpose of accounting is to help measure and report a business's profitability. The extent of the reported profit or loss can communicate the success or failure of a business with regard to its goal of profitability. In this chapter, we're going to look at how businesses measure business income as it relates to the very important goal of profitability. Our objectives in this chapter are to, first, define net income and explain the assumptions underlying income measurement and their ethical application. We're also going to define accrual accounting in Objective 2 and explain how it is accomplished. We're going to, in Objective 3, identify the 4 situations that require adjusting entries and illustrate typical types of adjusting entries. In Objective 4, we're going to prepare financial statements from an adjusted trial balance. And 5, we're going to explain and prepare closing entries. And then lastly, we're going to look at accrual-based information and analyze cash flows. So let's first start by moving to Objective 1, defining income, net income, and explaining the underlying assumptions relating to the measurement of income and its ethical applications. As we mentioned in Chapter 1, there are 2 goals of businesses, profitability and liquidity. The focus of this chapter is the goal of profitability, which is really what communicates the apparent success or failure of a business. To survive, a business must earn profits, at least on a fairly frequent basis. Profit, as a term, though, may be somewhat ambiguous. Lay people or the public may think earning cash is equal to earning profits, or generating cash from the sale of stock is equal to earning a profit. However, that's not technically correct. Net income is the preferred term from an accountant's perspective and can more precisely define the accounting point of view as it relates to profits. Profitability has many meanings, but from an accounting perspective, net income is more specific. It can be precisely defined as the excess of revenues over expenses. Simply, when net income is greater than revenues, when revenues are greater than expenses, we have a net income. When expenses exceed revenues, then we have what is called a net loss. There are actually 2 components of net income. The first are revenues. Revenues are just basically increases in our stockholders' equity via the retention of earnings due to selling goods or services that are the normal business activities of that company. It is not when we sell our own equipment or trucks or buildings if those items are not part of our normal business that we're operating in. So for instance, a real estate company may be in the business of selling buildings or land. However, a manufacturing company is not in the business of selling equipment or land, buildings or land. So therefore, the revenues for a manufacturing company should not include the income from the sale of any buildings or land. Not all transactions that increase cash are considered revenues. So for instance, we can have increases in stockholders' equity from the sale of stock, But that is not the generation of revenues for that business because our company is not primarily engaged in the sale of stock. It's selling stock to help fund things for the business, but that's not what they're in business to do. Bank loans are another example. Bank loans can increase our cash, but they do not produce revenues. The collection of accounts receivable, those can result in cash being increased and an account receivable being decreased. But the sale actually takes place when the item was sold on account. That's when the revenues were generated. So what we specifically need to look at with regard to revenue in terms of profitability is we want to look at revenue when it is earned, when the business sells the things or performs the service for either cash or on account. Those specific things are what we call revenues for a business. The second component of net income is expenses. Expenses decrease stockholders' equity, and they are items that result from the activities that help to generate the revenues. The cost of goods to sell a product or service are part of our cost of doing business, and those are what we are considering to be expenses. Expenses are things that help to generate revenue. They take resources out of the company for the specific purpose of hopefully helping the company to sell items. So things that might be included in expenses are any costs or activities necessary to carry on the business's activities and the cost of attracting and serving customers. So for instance, things like salaries, rent, utilities, depreciation, all of those things would be considered expenses of the business. However, just like with our revenues, not all cash transactions that are payments are expenses. So for instance, the repayment of a loan, that is not an expense. The interest on the loan would be an expense, but the actual repayment of the loan is not an expense. Decreases in stockholders' equity associated with dividends. Again, those are not expenses of the business. Those dividends don't help us to generate revenues for our business. They help us to attract stockholders to invest in our business, but they don't help us to sell our products or services. With respect to expenses, there may actually be a two-step process to incurring an expense. So for instance, what do I mean? I mean things like prepaid items. So for instance, let's say you pay cash in advance for rent or insurance, and you create a prepaid asset at that time. You have not necessarily incurred an expense yet. You have not necessarily incurred that expense yet. When you use up that asset or expire that asset, that is when the asset is actually allocated to the expense. It is at that time that we would debit the rent expense and credit the prepaid rent. So if we look at this from a transactional perspective, paid 6 months rent in advance, we would debit our prepaid rent and we would credit our cash. That's when the cash transaction, the cash piece of the transaction takes place. Our cash outflow takes place then. However, the expense has not been incurred yet. At the end of the month, when we've used up that rent, we've operated in that building for that month, that's when we've incurred that expense. We've used it up. That's when we would allocate that rent to rent expense and reduce the prepaid rent asset. So we would do a debit to rent expense and we would credit our prepaid rent account. Similarly, we have things such as plant equipment, plant assets, buildings, equipment, land. We would purchase those assets for either cash or using a loan and debit the asset on the balance sheet. But then, as the asset is being used up or expired, we would depreciate that asset over time. We would allocate a portion of the asset in each of the accounting periods to show that we are using up that asset. We would do that by then debiting our depreciation expense for that asset and crediting what we would call an accumulated depreciation account. We will learn more about the process of depreciating an asset in future chapters. So, with regard to our expenses and the relationship to the assets, we would say sometimes that expenses are the costs of a business and they take the resources out of that business. So clearly we can see how it's very important that we are accurately measuring our revenue and our expenses and matching them up in the appropriate accounting periods. As we move on to the next slides, we're going to talk about some of the measurement principles or the accounting principles that relate to ensuring that we properly account for the profitability of our company. So, the generation of all techniques of income measurement rests on the assumption of continuity. The continuity issue assumes that a business will continue over accounting periods indefinitely. Revenue and expenses may span several accounting periods, and activities that may occur in one accounting period can carry over into another accounting period. Accountants must assume, therefore, that a business will continue to operate indefinitely unless there's evidence to the contrary. This also relates to the going concern principle. The going concern principle assumes that a business will continue to operate indefinitely. The continuity assumption allows accountants to assume that the costs on the balance of a business will be expensed in future accounting periods and matched with the revenues that they will generate. If a firm is not considered a going concern, financial statements may be prepared on the basis of what we would call liquidation value of the assets. That is when we think that those assets may be converted to cash, and so therefore we value them at their cash value at that point in time. Other accounting profitability issues relate to the accounting period issue. Sometimes businesses may have some difficulties in assigning revenues and expenses to a specific period of time, whether it be a month, a quarter, or a year. Not all transactions can be easily assigned to an accounting period. So for instance, the purchase of equipment or a building, you might use that building or equipment for many periods. So how do you allocate the expense associated with that building over time? Additionally, you might have sales of some items that, again, take place over time. So for instance, a company that, say, constructs a road or constructs some sort of customized software. It may take many actual accounting periods to actually construct that road or construct that software. We have to keep in mind that net income is often just a best estimate, and many transactions can span multiple accounting periods, and accountants must apply measurement techniques between periods based on estimates for allocation of revenue and expenses accordingly. The assumptions that they make must be consistently applied from year to year and period to period. That's where the periodicity principle comes in. Businesses must make assumptions about the period of time for their accounting measurement and measure net income for that period of time consistently from year to year. Fiscal periods do not have to correspond to a calendar year, as we've discussed previously, but they can be any 12-month period as determined by the needs of that particular business. The time period for a business is always noted in the financial statements for a business. And if you look on page 135 in your textbook, you'll see a reference to this. Businesses also have what we call interim periods. These are accounting periods for less than 1 year to measure data such as on a monthly, quarterly, or semi-annual basis. The next issue that businesses must deal with with regard to ensuring ethical profitability measurement is the matching issue. Sometimes smaller companies work on a cash basis. This is an uncomplicated approach to recording and valuing our revenues and expenses. However, the cash basis doesn't necessarily take into consideration transactions or allow for the accounting for accounts receivable and accounts payable and things of that sort. The cash basis of accounting recognizes revenues when cash is received and expenses when cash is paid. And again, it works for many small businesses, but not many larger businesses. Income taxes, most businesses must use a cash basis for the purpose of calculating taxable income. However, a cash basis is not a complete picture of a business because most businesses make sales on accounts or make purchases on accounts. So they have to ensure that receipts and expenses are recorded in the correct accounting period. This is where the matching principle comes into play. We want to recognize revenues or assign revenues to the accounting period in which the goods or services are sold, and the expenses assigned to the accounting period in which they are used up to produce those revenues. If the matching principle is not applied correctly, it may lead to investors or stockholders being misled about the profitability of the company. So these 5 different principles that we've just discussed help to ensure that our company is measuring their profitability appropriately and correctly and maintaining ethical financial reporting. The following are several questions for you to answer. You will receive the Google form to respond to these questions for Objective 1 of Chapter 3. Now we're going to move on to Objective 2, defining accrual accounting and how it is accomplished. Accrual accounting attempts to record the financial effects of an enterprise of transactions and other events for a business and circumstances relating to that business in the period in which those transactions, events, or circumstances occur, rather than only in the periods in which the cash is received or paid for by the business. So accrual accounting is basically an application of the matching rule. When revenue is recorded before cash is received, accrual accounting does not require a receipt of cash to recognize the revenue. We allow for the recognition of the revenue by recording an account receivable. So we say that we record and recognize revenue when it is earned, and we record and recognize expenses when they are incurred. And then we use adjusting entries to help us account for any adjustments that need to be made after the fact. So revenue recognition is the process of determining when revenue is earned. Example is sales on account. This is where we record revenue before cash is received. But we want to be able to do this because we want to be able to reflect that we've actually earned that sale at that point in time, not necessarily when the cash is received. Expenses that are incurred is the process of recognizing expense has been incurred even though we may not have yet paid for it. So for instance, if we have been using our telephone for the past month and then we receive that bill, we may not pay that bill for maybe several days or weeks later, but we have to recognize that we've used our telephone for the past month and we've incurred that expense. Adjusting entries are the second part of the accrual accounting process. They ensure accounts are updated at the end of a fiscal period to bring any account balances up to date. Those transactions that span cutoff periods must be adjusted or allocated to the proper accounting periods. So a prepayment of 6 months office rent has to be adjusted on a monthly basis to accurately reflect in the financial statements that we've used up that prepaid asset over that period of time. Adjusting entries are prepared at the end of an accounting period, each accounting period, whether it's a monthly, quarterly, semi-annual, or annual period. They also do not affect the cash flow. The adjusting entries never impact the cash account. Examples are supplies, depreciation, and prepaid insurance, and we will be talking more about these in the future objectives for this chapter. Additionally, adjusting entries require judgment and can lead to, if they're not handled properly, improper application and abuse. So we have to make sure that they're accounted for properly. And that is because they obviously affect the profitability of our business. Adjustments help us to ethically and appropriately account for our revenues and expenses. In addition, the Securities and Exchange Commission has identified that accrual accounting and adjustments are an area for potential abuse and misrepresentation, so they have to be handled properly. Adjustments affect the performance measures of profitability and liquidity, and again, so therefore must be handled properly. Adjusting entries can affect net income on the income statement and profitability comparisons between accounting periods. They can also affect the asset balances and liabilities balances on the balance sheet and a company's future cash inflows and outflows. And that leads us to our discussion questions for Objective 2. And you're going to identify and answer these again in a Google form that will be sent to you. And that brings us to the end of Objectives 1 and 2 for Chapter 3.